China's economy, once a powerhouse of global growth, now faces a steep and steady decline. Despite sweeping fiscal and monetary measures from the government, the brief development in stock markets has faded, revealing deeper issues in industrial stagnation and a faltering real estate sector. Under President Xi Jinping, shifts in legal and economic policies have prompted foreign investors to pull back, and consumer confidence has waned, leading to widespread market withdrawals. With diminishing demand, falling factory prices, and mounting debt, China's economic future hangs in the balance. Will current policies turn the tide, or is the downturn beyond repair? But before we start, don't forget to like and subscribe to our channel, China Fact. We really appreciate your support. Thank you so much. China's economic downturn seems inevitable. To address the ongoing decline, the Chinese government has recently implemented a range of fiscal and monetary policy measures aimed at revitalizing the economy. While the stock markets in China and Hong Kong initially saw a brief surge due to the government's loose monetary stance, this uptick has proven to be fleeting, offering little lasting effect on China's industrial economic framework and investment climate. Essentially, if the current trend of economic recession is not reversed, the market capitalization of Chinese listed companies is unlikely to grow. In terms of the real estate sector, prior analyses, including reasonable expectations, have indicated a continued drop in property prices. The stimulus initiatives from the People's Bank of China regarding real estate are unlikely to change this downward trajectory. The predominant source of pessimism regarding China's economic outlook stems from its deflationary characteristics. Many draw parallels between China's present circumstances and Japan's historical deflation and weak demand. However, notable differences exist, particularly concerning their levels of economic advancement and differing political systems, which influence economic growth trajectories. This notion is underscored by the insights of Darren Acemoglu, Simon Johnson, and James A. Robinson, recipients of the 2024 Nobel Prize in Economics. The interplay between political and economic systems plays a vital role in national prosperity. Since Deng Xiaoping's era of reform and opening up, transformations in China's economic framework have steadily enhanced its economy and living standards, positioning China as a critical export destination for numerous countries globally. Nevertheless, under President Xi Jinping, the credibility of China's economic and legal frameworks has significantly eroded, leading to a persistent decline in foreign investment. Thus, the downturn of China's economy is intricately linked to Xi Jinping's influence on its legal and economic landscapes. Since Xi's ascent to power, the Chinese economy has endured various shutdowns, notably the 2-year zero-COVID policy that halted trade. Recently, politically sensitive regulations have led foreign businesses and individuals to fear potential hostage situations in the event of conflicts, resulting in significant capital flight and a notable withdrawal from the Chinese market. The Chinese government's interventions have led to a steady drop in consumer demand. Data released by the National Bureau of Statistics on October 13th indicated that in September, the Consumer Price Index, CPI, in China increased by merely 0.4% compared to the previous year, a decrease from August. Despite this slight improvement over last year, the growth in prices remains limited. With a low annual CPI growth rate, even a minor decline in the prices of widely consumed goods can lead to a negative annual growth rate. This suggests that China's domestic consumption power is currently inadequate. When consumer sentiment is pessimistic about the economy, it becomes increasingly challenging for government initiatives to yield the desired outcomes. Moreover, the Producer Price Index, P, for September fell by 2.8% year-on-year, marking the steepest decline in 6 months. China has witnessed negative PI growth for 24 consecutive months, indicating a continuing drop in factory prices closely linked to the country's issue of overproduction. As demand remains insufficient, various economic organizations and forecasting bodies have expressed skepticism about China's ability to achieve its 5% economic growth target. Nonetheless, with the People's Bank of China and the Ministry of Finance announcing relaxed monetary and fiscal measures, the government may strive to infuse additional funds into the market to attain this growth goal. As Adam Smith noted, productivity is the cornerstone of economic growth. Enhanced productivity typically results in improved economic performance. If government initiatives do not boost productivity or research and development, expansionary policies may merely elevate debt without promoting sustainable growth. Therefore, assessing the health of China's economy requires not just a review of economic figures, but also an evaluation of the opportunity costs related to policy implementations to gain a precise understanding of China's economic outlook. In the third quarter of 2023, China's GDP growth decelerated to its lowest level since the beginning of the year. Although the CCP is often accused of inflating statistics to enhance the country's image, the official data released by the CCP on October 18 revealed a year-on-year growth of only 4.6% in the third quarter, the slowest since early 2023. The real estate sector, in particular, is experiencing a downturn. Data from the National Bureau of Statistics of China indicated GDP growth rates of 5.3% in the first quarter and 4.7% second quarter of 2023. Dropping further to 4.6% in the third quarter. This trend shows that China has fallen short of the CCP's 5% growth target for 2 consecutive quarters. Throughout the initial 3 quarters of 2023, China's economic growth reached only 4.8% year-on-year, raising doubts about the authenticity of these figures provided by the CCP. As the real estate sector stagnates and exports decline, both industrial output and retail sales have also weakened. Industrial output rose by 5.8% year-on-year, while retail sales saw a modest increase of only 3.3%. Nonetheless, real estate investment in China has declined by 10.1% compared to the same period last year, while new home sales have dropped by 22.7%. Indicating that the real estate market is still undergoing significant adjustment and nearing a low point. With 70% of household wealth tied up in real estate and the industry once contributing a quarter of the economy, these recent figures illustrate that consumer spending remains muted despite several rounds of policy support from the Communist Party of China over the past year. Recent data shows no signs of recovery in the real estate sector. China's new home prices are experiencing their steepest decline since May 2015. In addition, crude steel production fell for the 4th consecutive month in September, contradicting hopes for a rebound in construction material purchases. The export sector, previously a bright spot in the economy, is now beginning to falter, as shipment growth slowed significantly last month. According to recent figures from China Customs, exports increased by only 2.4% in dollar terms in September compared to the previous year, a sharp decline from the 88.7% growth seen in August. Imports also remained weak, rising just 0.3%, both well below forecasts. This suggests that manufacturers are reducing prices to clear out inventory ahead of impending tariffs from various trading partners. Historically, China has depended on infrastructure development, manufacturing investment, consumption, and exports to propel economic growth. But investment has stalled, consumption has weakened, and exports are now also declining. Economist Bruce Pang, chief economist at GEL, noted to Reuters that the third quarter of 24 looks bleak due to weak domestic demand, a struggling real estate sector, and slowing export growth. This performance aligns with market forecasts. A Reuters survey indicated that economists expected China's economy to grow by 4.5% year-on-year in the third quarter. The same survey projected a 4.8% growth rate for 2024, falling short of Beijing's target, with an anticipated decline to 4.5% in 2025, potentially exacerbating deflationary pressures. China has been grappling with deflation since early last year, and some economists believe recent data indicates that these pressures are intensifying as the outlook for exports, the last remaining bright spot in the economy, has dimmed due to foreign trade restrictions from several major trading partners. The concerning decline in export momentum has increased pressure on Beijing to introduce measures to boost demand. GDP data confirms that China is facing a scenario of oversupply and inadequate demand. China is considered to have fallen into full-blown deflation, remarked Toru Nishihama, chief economist at Daiichi Life Research Institute in Tokyo. In response, China has rolled out several measures in recent weeks aimed at stimulating economic activity, such as lowering mortgage rates for existing homes and permitting banks to enhance lending by reducing reserve requirements. Nevertheless, industry experts assert that many of these initiatives are superficial. Observers of the Chinese economy have consistently emphasized the necessity for officials to confront enduring structural issues, including overcapacity, excessive debt, and an aging demographic. Concerns have emerged regarding the stock market's potential to drain savings from the public. Recently, the Chinese stock market has experienced significant fluctuations. On the evening of October 20th, 23 companies listed on the Shanghai and Shenzhen exchanges announced their plans to utilize bank loans for stock buybacks or share acquisitions. A senior accountant from the mainland cautioned that this could be a deceptive strategy. The Chinese Communist Party, CCP, appears to be leveraging the stock market to extract deposits from average citizens in pursuit of this year's GDP growth target. On October 20th, these companies revealed that they had entered into loan agreements with banks to secure financing for their stock repurchase and share purchase endeavors. Among the 23 companies, SEC, China Merchants Shoe, Catcher, Costco Shipping Energy, and Costco Shipping Development collectively applied for nearly 11.5 billion in loans for repurchase and share acquisition purposes. For example, SIP entered into a credit agreement with the Bank of China, securing nearly 900 million yuan for stock buybacks, while China Merchants Shoe obtained a loan of 702 million yuan from China Merchants Bank for the same objective. On the same day, Jiang Securities in the mainland announced the conclusion of the stock market's downward trend since the 8th, forecasting a high likelihood of a rebound against the 3,674-point decline. Analysts observed that the fluctuations in the stock market are orchestrated by the CCP. Nonetheless, Ms. Yu, a senior accountant on the mainland, expresses skepticism regarding the emergence of a new bull market. She warns that there is an underlying trap associated with the recent stock market surge. On October 21st, Ms. Yu informed the Epoch Times that the recent rise in China's stock market was a result of CCP manipulation. She perceives the Chinese stock market as a scheme, even though many ordinary citizens remain unaware of the potential pitfalls. Like outsiders, we within the system are aware that the government is currently exploiting the stock market to siphon off people's deposits to meet the 5% GDP growth target, she remarked. As the fourth quarter approaches, they recognize that achieving the 5% GDP target established by the top leader this year is unlikely. The economic situation is poor, the real estate sector is struggling, and the three key drivers of GDP growth, investment, consumption, and exports, have all stalled. To bolster GDP, officials seem to be focusing on public deposits, speculating that citizens have unspent money available. Consequently, the government has devised strategies to encourage individuals to withdraw their funds, invigorate the stock market, and potentially enhance GDP growth. Data from the People's Bank of China indicates that by the end of 2021, the total deposits of Chinese residents had reached 10.3 trillion yuan. Recently, the mainland's Oriental Red Asset Management released its equity strategy outlook for the fourth quarter of 2024, revealing that the deposit balance of Chinese residents has risen from 10.3 trillion to 14.7 trillion yuan. Ms. Yu further stated that top leaders, the central bank, and the Ministry of Finance have recently been advocating for the stock market, announcing an initial investment of 500 billion yuan in incremental funds, with an additional 500 billion to follow. She believes the aim is to draw people into the stock market, although the funds are not being injected all at once, but rather released gradually in smaller increments. In conclusion, China faces a significant economic downturn with minimal effects from government fiscal and monetary policies. The real estate sector is declining, driven by weak consumer demand and deflation. Under President Xi Jinping, confidence in China's economic frameworks has diminished, leading to reduced foreign investment. Despite efforts to stimulate demand, stagnant GDP growth and persistent structural issues suggest a bleak economic outlook, raising concerns about the country's long-term viability and global implications. Finally, if you're eager to explore the issues of China, join us on the China Fact channel. We provide accurate information and in-depth analysis of significant events. Thank you for being a part of our journey.